Ladies and gentlemen, good day and welcome to the Apar Industries Limited Q1 FY23 earnings conference call. As a reminder to all participants, line will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nihar Mehta from Essential Technologies. Thank you, and over to you, sir.
Hi, a very good afternoon to everyone. This is Nihar Mehta from Essential Technologies. On behalf of the management of Apar Industries, I would like to thank all of you for participating in the earnings conference call for the first quarter of FY23 for Apar Industries. To discuss the business performance and outlook, we have from the management side, Mr. Kushal Desai, who is the chairman and my managing director, Mr. Chaitanya Desai, who is the managing director, and the CFO, Mr. Ramesh Iyer. I would now like to hand over the mic to Mr. Chaitanya Desai.
Thank you. Good afternoon, everyone, and a very warm welcome to the Q1 FY23 earnings call of Apar Industries. I will start with an overview of our performance, followed by a quick industry update, and then get into details on the segmental performance, post which we can open the floor to questions. For Q1 FY23, the consolidated revenue came in at 3,093 crore rupees, up 71% year-on-year, driven by both volume growth and price increases from commodity values across segments. Export revenues is up 76% year-on-year, contributing to 42% versus 41% in the previous year. EBITDA is up 73% year-on-year to 239 crore rupees at a margin of 7.6%. PAT came in at 122 crore rupees, up 97% year-on-year with 4% margin versus 3.4% in Q2 of FY22. All three divisions contributed to the performance, which is the highest reported quarterly profit till date. I will now cover a few industry highlights. Total outstanding dues owed by electricity distribution companies, the DISCOMs, to power producers rose by 4% year-on-year to 1,32,432 crore rupees in June 2022. On a sequential basis, total dues in June increased from 1,30,139 crore rupees in May of 2022. India is poised to add 27,000 circuit kilometers of interstate power transmission networks by 2024, as it has already added 6,500 circuit kilometers, or almost one-fourth of the target. The power transmission network expansion has been planned keeping in mind the ultimate goal of having 500 gigawatts of non-fossil fuel-based electricity generation capacity in the country. The Power Ministry official also said that in addition to 27,000 circuit kilometers by 2024, India would need to build transmission lines to evacuate 180 gigawatt generation capacity, which will ultimately help the country to realize its goal of having 500 gigawatts of renewable energy by 2030. According to the latest report released by the Central Electric Authority, the overall target for substation transformation capacity addition for FY23 has been set at 95,659 MVA. This is 17.3% higher than the comparable target of 81,545 MVA for FY22. In terms of voltage class, the bulk of the target, 44.5%, will come from 400 kV substations. The 765 kV class will account for 28.2% of the target, while the 220 kV category will make up the remaining 27.3%. The current geopolitical environment has forced India to further expand its defense capabilities, and it has cleared the purchase of indigenous military hardware worth 76,390 crore rupees to sharpen combat capabilities with next-generation warships, wheeled armored fighting vehicles with anti-tank guided missiles, radars to locate weapons, and tanks to lay bridges. All these infrastructure investments will lead to increased demand for our products and services. I would like to now cover segmental highlights. Conductors revenue in Q1 FY23 grew 128% year-on-year to reach 1,548 crore rupees with 64% year-on-year growth in volumes, mix improvement and increase in commodity prices. Exports grew 120% year-on-year, contributing 42% to revenues. The premium product contribution increased to 47% from 44% in Q1 of FY22. The EBITDA per ton post-adjustment was at 21,933 rupees. This is a historical high, and it contributed due to an improved mix of premium products. New order inflow came in at 2,017 crore rupees, up 30% year-on-year. In Q1 of FY23, our oils revenue was 1,068 crore rupees, up 28% year-on-year. Exports contributed 43% to revenue. The EBITDA per KL post-adjustment came in at 9,712 rupees. Margins were elevated in this quarter as the weighted average cost of inventory was comparatively low. There have been supply chain issues with the higher priced base oil deliveries getting delayed by several weeks, resulting in lower cost basis in Q1, but will be followed by a very sharp increase in Q2. This will affect margins in Q2 for sure. Lubricants revenue was 217 crore rupees, up 36% year-on-year, driven by volume growth in industrial oil business. In Q1 of FY23, our cables revenue reached 638 crore rupees, up 60% year-on-year, with strong growth across all sub-segments except optical fiber cable sales, which were impacted by muted telcos business. Power cables revenue was up 60% year-on-year, and elastomeric cables revenue was up 84% year-on-year. Exports contribution at 43% versus 19% in Q1 of FY22 was the main contributor to the increase in power cable sales. Sales into the renewable energy installations, railways for both locomotives and coaches, and increased purchase by the defense factories all resulted in the higher sales of elastomeric cables. We are running all three E-beam machines at full capacity. The fourth E-beam machine and new plant to produce windmill cables are at an advanced stage of installation, with commercial production in both units likely to start in Q3 of FY23. These expansions are well timed and will increase overall sales in H2 of FY23. The EBITDA post-forex adjustment
sales will go up, but it will not impact the bottom line in terms of a per unit level. And therefore, we kind of measure our business also in terms of per unit, because if you look at percentage, then it will be too much wavering depending on how the commodity prices go.
So I can just add to what Ramesh has mentioned here, that both aluminum and copper are down between 25 and 30% from their all-time highs. Right. So there will be obviously an impact in terms of the per kilometer cost or per ton cost of the product. However, we will also see steady revenue coming in on these products. And as Ramesh has mentioned that we calculate an EBITDA per ton for operating costs, and then we adjust that for interest. So the interest cost also will marginally come down, because the billing value will come down.
Right.
So over the years, I don't think you will see. Yes, you will see some movement on the top line, but I think the bottom line will continue in this, with this sort of level.
Okay. So with, the last time our commentary mentioned that we probably expect the share of conventional conductors to go up. But with 54% of our order book right now being high margin business, do we expect these EBITDA per ton level, per unit level to sustain?
So we expect our EBITDA level to be in the range of about 17,500. That's the kind of number we expect, around 17,000 to 17,500. And of course, the quarterly numbers will actually depend on the level of execution that happens, because these are all make-to-order business where sometimes it takes longer gestation period to manufacture, and then there is a lot of inspection involved. So we look at it from a long-term perspective. 3 months perspective may be very short to kind of conclude that whether a particular level of EBITDA will continue. But then we do expect that if our high premium products have a more than close to 50% share, the EBITDA are likely to be on the range of about 17 to 17,500 per metric ton.
Understood.
Also, if I can add to what Ramesh is saying, that the gestation cycle for the execution of the orders is getting a bit faster. So even the HTLS, which is reconductoring jobs, compared to what the cycle was pre-COVID, and then of course during COVID it got really messed up because of various project-related issues. But going forward, the gestation cycles are also getting better. So I think that should also help improve some of the rateability that we have.
Okay. So what would be the execution period for our current order book of 3,600 crores?
Should be about a year, close to about a year.
Okay. Okay. And on cable division, the new E-beam machine that we are expected to commission in Q3. So if this were to run at optimum capacity, what would be the revenue potential from this one at current scenario?
So I don't have a straight answer for that, but the product really goes into it. It depends on the product mix that we have, because it will be used both for the railways, locomotives, and railways, as well as for some of the bigger cables that are required in the ships. But our expectation is that you will probably get somewhere in the range of around 5 to 6 crores on this front, and then certain other cables will be manufactured on this at a faster speed, opening up our services revenue. So probably somewhere in the range of around 7 to 8 crores per month.
Per month. Okay. Okay.
And it also depends very heavily on the mix of cable, because for some of these specialized cables, the insulation is very, very different. So even though the copper and aluminum, most of them are copper, that copper is standard in terms of its performance requirements. The insulation is very, very dramatically.
Okay.
So essentially what will happen is that most of the cables which we make are made, 2.5 machines are used for cable and half a machine is used for services. So when you add the third, it will become equivalent to 3.5. And our sense is that within a year we will be completely loading this machine up.
Okay.
Also, we make solar cables on this. So at the moment, we have not been taking a lot of solar orders because the 3 machines are running flat out, and solar cables compared to railway and defense, are lower margin. So when this machine comes up, then, we'll be able to do that. We've also started exporting solar cables into Europe. And that's a big opportunity that's opened up, given the very high cost of power there. More and more European manufacturers are looking at supplies coming from India.
Okay. And how do we look at OFC market? Like, are we seeing any, improvement in near future? Do we foresee the demand to pick up, especially because prices seem to be rising?
So just recently, the government has made some announcements where they will recapitalize BSNL and MTNL. And so, as they roll out more networks, there could be a possibility of this growing. The OFC order book will probably grow in the next, 2-3 years from today. But our major thrust is actually on, export of power cables and on the elastomeric cables, where we are actually, moving faster away from the rest of the pack.
Okay. And
so for example, in the North American market, we have 18 UL approvals, which is the highest amongst all manufacturers in India. And without a UL approval, you can't, it has to be marked on the cable, you cannot supply it. So we've focused on, those markets where we think, there will be a steady demand coming up, year on year. The optical fiber, it's a completely separate unit. It has a separate team. They'll continue to push for as much business as they can get. But the fortunes of the company will not depend on what happens to OS.
Okay. Last question. What was the capacity utilization in Hamria this quarter?
So we've just gone through with an increase of almost 30% in terms of debottlenecking storage and some of the blending, the bulk blending there. But as I said, Pratiksha, the capacity utilization for transformer oil and white oil, etc., one can speed it up. We don't run the plant on 3 shifts. It's run currently only on 2 shifts. So there's a lot of room there. It's really a function of getting the right, customer and order flow.
Okay. And currently, it's just the transformer oil where we are confident of demand sustaining, right?
Yes, the transformer oil side, I think everywhere there is a resurgence that's happening, even in countries in the GCC, where they are a very large producer of crude and petroleum products. They are also putting in extremely large installations, being part of this whole ESG, pledges which have been made. And most of these countries have a lot of sunshine. So right. The solar installations are, coming up, which will be very, very large in size. So our sense is that, the requirement for transformer oils and, cables mostly are produced locally, will continue to increase in that region. In the case of white oils, as we've mentioned, in some of the comments of our investor update, is that, all commodities have come down between 20 and 40% pretty much. But your petroleum products have not come down that much. Diesel has just corrected in terms of given the way we expect business to increase, on the elastomeric side, as we've already seen on for windmills, for solar, for defense, etc., that will take care. So of ensuring that the cable numbers, both top line, bottom line, will remain good. So you won't see really. We have a runway of a couple of years where at least these other products' growth will not really impact the amount that you spend on the LDC side and the wire side. So it should help us. And as I said, our target is that last year we did a little over 120 crores. This year we are targeting over 200, and next year between 4 and 500.
Okay. Yeah. And so I think that's a pretty large target, and I'm sure that you will achieve it. This is the second launch of Anushakti, right? We did one launch probably 4 or 5 years back.
So no, we have not really launched the product. It was really being sold only into the projects segment.
Right.
We hadn't really focused on doing a retail offering. We then took on a target market, which was Kerala, 2 years ago, and to see whether on the retail side we could end up getting good traction on it. And we found that moment you do the demo, especially to any independent house owner or someone who's redoing their own apartment, it is absolutely a no-brainer to use this. Because the amount of electrical intensity in any house is just increasing. You don't know today, after 5 years, how much power you're going to consume. And the worst thing for you to do is to rewire the house, because it will be a complete mess. All the paint and everything will get peeled off and all these things. So basically, it's literally like a wire that you take and forget, and the life on the Anushakti wire is already tested to be 50 years, because it uses the same fundamental technology as goes into, locomotives and ships.
Okay.
So it's basically a wire and forget kind of application. So I think I would not think that growth of that Anushakti will make a huge dent, in terms of the cable profitability. On the contrary, the brand will continue to get built.
So I was not worried about the profitability part. I'm more interested in knowing that how fast you can scale up, and that's what I wanted to know, that the people whom you have hired, the product side, on the branding side, the distribution side. So that's what we've taken the help of a top management consulting firm to sit and work out the entry strategy and stuff. So all that's already done, and it's just being rolled out. Okay.
That's how the numbers, we expect them to show some good growth.
And in terms of people hiring, whom you have hired to drive this?
So we've hired people who have primarily been in the trade, not necessarily just from wires, but in the electric trade. So, you've got a whole slew of products, which include switches, it includes lighting products, switch gears, etc. So we have, obviously worked on selecting good people, and because without investing in that, nothing can actually grow.
Sure, very true.
So there are 7 states in the south which we have already started. The people are on ground, and the business is starting, which are the 4 southern states, and then to that is added Maharashtra and Gujarat. Okay. And then in the north, we've basically started in UP, and then we'll be adding Haryana and NCR, the NCR region.
Sure. Just in the last question, and it's a bookkeeping question, what kind of capex we are looking for this financial year, and in which area which we will spend?
So total capex in this year, we expect about 150 odd crores. Roughly about 2/3 we expect to be in the cable division.
A lot of this is actually a carry forward of projects which were announced earlier. Like, so for example, if you take the 4th E-beam machine we have, and the CCV line, which is a state-of-the-art line for making these cables for windmills, those will get commissioned this year. So, all kinds of part issues were there, all machinery delivery also running 6 months behind schedule because of electronic parts and things like that. So it's really a carry forward of allocations which were done in previous periods, which will get completed this year.
I think we are setting up for a 4th E-beam machine, right?
Yes.
Yeah. And that will come in which quarter?
In the 3rd quarter.
The 3rd quarter. Okay, great. Thanks, and wish you all the best.
Yeah, thank you.
Thank you. Next question comes from the line of Pawan Nahar, an individual investor. Please go ahead.
Gentlemen, congratulations. Kushal bhai, Apar bhai, Chaitanya bhai. It seems we are pretty much on track for the 20% ROE number. So, congratulations.
Thank you.
Second was, I just wanted to understand how much would have the inventory gain been in this quarter for the oil business?
So, it's I would call it a margin gain. Right. So that the margin gain actually, typically you would have had, between 5 and 6,000. So it's been a little bit, so the difference between the two, which is about 3,000 odd KL, is part of, the lower cost structure being in place. So in the following period, you will see a big step function increase. So in some cases, you've already increased prices to, or partly increased prices to customers. So the unit margin is showing higher in the month of June. In the month of July, August, that unit margin will fall until we are able to make another price increase to rationalize the whole thing.
Sure.
So we are looking at a levelized number, in the range of typically, 5,000 rupees a KL. And as Ramesh mentioned, we've been quite cognizant of adjusting that, taking interest as a variable cost.
Okay.
The rest of it is like pretty much a pass-through, right, in terms of blending and other areas that you refix from time to time. But as the interest rates move up, we've been factoring that in, to the cost which we have.
In fact, that would be a lovely way to look at it, because I was myself wondering if we could look at both the oil business, the conductor business, EBITDA after the oil, the interest cost, right, to simplify it for us as outsiders. So
we have that working, which is there, and Ramesh was contemplating, introducing that as an additional measure. It's just that most analysts, and most of the people who are on this call, they are used to a certain metrics, but we can obviously provide both.
It will be really very, very nice, because I right now in the screen I have data for the last 13 years in terms of spreads for each of both the businesses and margins for cable. So I okay, before I get there, I wanted to ask you now, what would be the volume growth outlook for the oil business for the full year? Last year it was 460K. Earlier, I think we spoke about 6.5% volume growth. So would you like say that ballpark 490, 500,000 KL would be the number, volumes?
So our expectation is, and the business plan that we've made is, looking at almost constant volume over the previous year and this year, simply because there has been, so much of increase, and diesel is if you see in terms of the mix of product that's coming out from a crude barrel, is just diesel and aviation fuel, which is, above the watermark. Even gasoline is right at the price of crude, or in some markets even slightly below that. Naphtha is $25 below. So, it's been a standout and not come down, whereas all other products have come down. So wherever you have substitution, like in white oil, that volume will get affected, and affected. So I think it would suffice by saying that this year the bottom line for the conductor business will be higher than what it was for the last year.
Yeah, yeah. Now this is much more clear to me. Basically, you're saying 17,500 is after factoring in the interest cost.
No. We want to clarify that.
Yeah. So 17,500 will not be after factoring the full interest cost that we have, but of course some part of the interest cost we would be factoring that. But it may not be right to say that we will get 17,500 post 100% of the interest cost.
We can share with you the working which you have suggested. That is the EBITDA that is coming close to maybe 14,000.
That slide actually can be added to the investor deck, in the next week and put up there. So then the working becomes relatively clear in terms of what happens. It can be an additional slide which gives an idea in terms of what happens post, this.
Sure. And on the cable business, we should just continue to assume 2,400 crores of revenues for the full year and about 8.5% margin?
No, our expectation on the cable side is to grow by 30%. So last year was about 2,000 crores net sales.
Right.
So this year we are looking at 2,600 plus.
And 8.5% margin is a okay number to go with?
Yes, it should be in that range.
Okay. And sorry, but if you can guide a little bit on the interest cost, this 60 crores this quarter, it was 108 or 50, 46 prior to that. What should we assume as a full year finance cost? Should we assume 20% drop next quarter and then maybe like 210 crores of interest cost for the full year?
So I'll tell you what happens in this interest cost. There are basically two components. One what drives is this pure interest rate, which is SOFR based on our LC, that gets factored into our interest cost. The second component is that since we have an import creditors, a lot of mark to market on our overseas creditors also gets factored into interest cost, because that's the way the accounting regulation needs to show you there. And therefore, if you see our EBITDA numbers, we have two kinds of EBITDA. One is the EBITDA and one is the EBITDA post adjustment that we call post forex. So there are multiple variables here, and I think once we put up this slide on EBITDA, which will be clear in terms of after adjusting for all sorts of interest costs, what is the net margin that we have made in Q1 of FY23 as well as possibly the trailing 4 quarters of FY22. Otherwise, because of multiple variables, it may be difficult to project that interest, because it's not only the interest rate, it also depends on the price of oils, aluminium, as well as the exchange rate that's happening. So it's difficult to give a particular number as to how this interest line will move.
No, so I got it, Chaitanya. So basically, this is something, thanks for clarifying. So basically, if I were to look at finance cost, after removing the adjustments which get knocked off from the EBITDA per ton or unit calculation, how much would that be? So 60 would drop to how much if I remove those adjustments? Because that is captured in the EBITDA line. We've reduced the EBITDA per unit.
So out of 60, about 20 would be your forex adjustment, which we kind of report EBITDA post forex. Out of the 40 would be your pure interest cost on LCs, which is suppliers credit.
Got
so
it.
What we do is that when we put up this annexure, we'll give a breakup of the 60 crores across the three categories, which will clearly show you how much is the EBITDA and then the interest cost and also the total finance cost, so that you can measure on the EBITDA number, because all our interest costs are actually factored into the pricing, so that will move up or down depending on the interest rate movement.
Got it. And for today, as we stand, 40 crores is the number for Q1, and commodities that we deal with are down about 20%. So we can assume maybe let's say around 30 crores if we were to just simplify it for a moment. Going ahead.
Yeah, I think we'll have to do the maths of it, but once this slide is put up, and possibly then we can be in touch to see how that number goes.
Okay, thank you so much, and all the best, and congratulations once again. Looking forward to that 20% plus ROE now.
Yeah, thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to one per participant. Should you have a follow-up question, we would request you to rejoin the queue. Next question is from the line of CA Garbit Goyal from Invest Research. Please go ahead, sir.
Hello. Am I audible?
Yes.
Okay. So basically my first question is what are your views on the sustainability of this transfer oil segment in long term, and what would be the impact of basically the renewable energy on this particular segment going forward?
So, in the case of transformer oil, as the renewable energy increases, the number of transformers and the transformation capacity will increase. It's a linear function. So, it will continue to grow. And in fact, earlier in the call, I mentioned that over the next few years, transformer oil seems like one of the product lines that we would expect to grow not only in India but also overseas.
So what kind of CAGR do you expect going forward for this particular segment in revenue and profitability terms?
It just depends on the rollouts. So, all governments around the world have made have thrown up very aggressive numbers. And, when you have such an aggressive number, it's anybody's guess what the final delivery will be like. But there will be a steady growth on the transformer oil side. That's all I can say. And it will continue for a few years as the infrastructure, gets built out. There's no real substitute for mineral-based transformer oil, especially in the transmission networks.
Okay, understood, sir. Understood. And from a conductor side, basically, I was going through your previous con call transcript summary, and there was mentioned that you will be having a volume of around 130,000 by financial year 23. At the EBITDA per ton, you are giving somewhere between 14,000 to 15,000. Now, is there any revision in this kind of guidance for financial year 23 for your conductor business?
As was discussed earlier, just now, by another question, he said that we are hopeful to improve the quantities, so it should be between 130,000 to 140,000 this year. And with regard to the EBITDA, as was also clarified, since this interest rates are going up, we are adjusting the EBITDA per ton so that at least the profit after interest is remaining intact. I hope that clarifies.
Okay, understood. And basically, I can assume going forward also, despite of the fact that the commodity prices increases or decreases, we are on the growth track for all the three segments, right?
Yes.
Okay. Understood, sir. Thank you.
Thank you.
In fact, we have been talking for several years about the US infrastructure market opening up, and finally it has opened up. So if you look at the mix of exports that are there and the growth in the exports which has come for the cable business and for the conductor business, the US is the single largest end market now. If you take the aggregate of these two, it is by far the largest market where, product is starting to go.
Okay, one more question from your product mix you are talking about. Actually, in the last phone call, I think you were mentioning that in this particular quarter from conductor business side, there shall be growth more from the conventional conductors, right? Am I right?
I'll clarify. Actually, last few years, due to COVID, there was a big dip in the volume. So what we had mentioned is that we are expecting the business on the conventional
the aspiration is to get into double digit.
That's great. So would it be fair to say that of the three segments, the cables is the one which is more faster or likely to grow the fastest?
Absolutely, because the addressable market is multiple times the size of the conductor market, and even if you take the entire specialty oils, segment, the domestic market is over 60,000 crores. With the largest company, Polycab, being below 10,000 crores if you look at just pure wires and cables on a net sales basis.
That's good to hear. So, and in terms of our capacity, current capacity, what would be the roughly capacity utilization at a very broad level for this segment? And what I'm trying to look at is what is the incremental capex would require to, grow, let's say 25-30% per annum for next 3-4 years.
So most of the growth which we are expecting, in FY23 and FY24, we have 65-70% of it has already been committed. Equipments ordered, they're coming in, etc., etc. It's wrapped around the number. It's wrapped within the number that Mr. Ramesh has given. About 100 crores coming on the cable side, and there's the formats which go into the US market also are a little bit different. So some equipments have been ordered for that, because that business also we continue to see, growing as the infrastructure needs get added up. And if the freight rates come down, then it makes India that much more competitive also. And which they will come down, because you're already seeing that consumer products are slowing down in the US. They carry a huge amount of, they hog a huge amount of the container inventory which is there. And one thing is container inventory, but it's also the ability to take the containers from the port and deliver it, because it's a large country. So when that comes down, then automatically it opens up for other products, and hopefully the pricing also should improve.
That's great to hear. So one other related question to this is, in one of the earlier calls when you were mentioning, on the conductor side, I remember when you were dealing with Australia, there was a double taxation issue which Chinese companies used to enjoy, and we had a 5% disadvantage compared to them. How does that compare for the US market? Are we at par with our other countries' counterparts from a double taxation treaty perspective, or we are still at some level?
The Europe does not have any special tax advantage to the Chinese cable suppliers. So
we are at par with anybody.
Level playing field on that front. In Australia, it's still the Chinese products are still at a lower tax level than Indian products, but there's a conscious move to reduce the product, the amount of product which is being purchased from China to increase the spread of the supplier base. And in the US at the moment, it's completely inverted, where the Chinese duties are more than 20%, the Indian duty is 5%.
That's great to hear. Nothing more from my side. Thank you.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to one per participant and not more than 5 minutes. Should you have a follow-up question, we would request you to rejoin the queue. Next question is from the line of Guneet Singh from CCIPL. Please go ahead.
Hi, sir. Am I audible?
Yes.
First of all, I would like to thank the management for answering all the questions of all the participants very with all details. And I would like to go ahead with my questions, and most of them would be forward-looking. So if we look at the margins, margins have been quite stable at around 6 to 7% since the last 10 years or so, I would say. But I see that we achieved margins of around 9% in, I think, FY 2017. So is it appropriate to say that we are past any efficiency improvements or any improvements in terms of improving the margin? So is this the peak margin that we can achieve, or the company is consciously taking steps to improve the margins or anything of that sort? And what kind of margins can we expect, like going forward for this year or maybe down the line 2-3 years?
So in terms of, I wouldn't say that these are peak margins, but given the large product profile and the relative complexity of different product lines that we have, our endeavor has been to improve premiumization, and that is now evident across all the three businesses. And this premiumization is both in terms of products and in terms of geographies. So I think what we've achieved here is the EBITDA margin is 7.6% for the quarter, and the endeavor will be to grow that. Now it all depends finally which products, which markets, etc. I think the number that we are really focused on is the return on equity, which we think we have a better handle on in terms of being able to deliver, and that number we are still focused on delivering 20% ROE. We are right now in the 17 odd % range.
All right. So for this financial year, can we expect to maintain the margins of around 7.6% or around 8%?
So I think we'll be able to maintain these margins. There will be a reduction in whatever is seen on the specialty oil and the lubricant side, but there will be some improvement that comes from the cable side because of the increase, in terms of the volume that will come.
All right.
I think overall you should still see something in this range on a higher volume number.
Perfect. So in terms of the growth drivers for the company, you mentioned that we're working 2 shifts right now. So would there be any capacity expansion or do we require that? And assuming across all our segments, if we run on full capacity, that is say 3 shifts, what kind of revenue can we reach in that sense? And also, if you have any plans for capacity expansion or any capacity expansion, can you please point those out as well and how they will impact our revenues?
So I had spoken about the 2-shift running at the Hamria facility in the UAE, and that theoretically can be scaled up. So as a consequence, just volume is not a constraint if we actually have the product and the business coming in from customers. The oil division is not going to have any very significant capex because we do have capacity in place. So it's just debottlenecking. There's investment going on in this industry 4.0, in terms of improving digitalization and all those sort of things. But they are not very heavy ticket, capex items. It's really the cable business that, as we continue to grow, most of these projects which are going in will take care of what we want to achieve in FY23 and to some extent FY24. If the market continues to remain strong, then that business we will continue to invest in.
Thank you. The next question is from the line of Akshay Kothari from Envision Capital. Please go ahead.
Yeah, thanks for the opportunity. So I wanted to know that you did mention that we got solar cables order from Europe and there was a good traction from that side. Despite that, our margins in cables business have been on the lower side, whereas other players are doing somewhat close to double-digit margins. So what would be the reason for this?
So players that have a higher margin profile are largely
Okay. And so lastly, on the hedging strategy, could you elaborate more on the how are we hedging? Is it through some embedded derivatives or how is that?
It's a plain vanilla hedging for the products that qualify for hedging, basically aluminum and copper. We do that hedging base for once we get an order from the customer, so immediately we do a back-to-back hedging at the LME, and that's how it happens.
So just to add to what Ramesh has said, the conductor business, because it's a made-to-order and each order is of a certain size, you pretty much hedge everything back-to-back, other than in the case of steel, where there is no hedging mechanism. Fortunately, steel has also started coming off. In the cable business, the larger orders which are there also we actually hedge back-to-back. So if, for example, Siemens Gamesa places an order on us, or Nordex, or any of these windmill guys, we would only go back-to-back on them. Where you have a little bit of open is when, you are servicing the dealer-distributor market, where it's not possible to predict, how much quantity will be involved. So to a very large extent, the requirement is hedged. There is a small portion which remains open because of the lack of being able to assign a customer, to the metal.
Thank you. The next question is from the line of Pujan Shah from Congruence Advisors. Please go ahead.
Sir, thanks for the follow-up. I just wanted to ask because Apar is a pioneer.
Mr. Shah, sorry to interrupt, but your voice is breaking up. Maybe request you to move to a better reception area.
Hello. Am I audible now?
Yes, sir.
Clear? Yeah. So Apar has been pioneer and been leader in conductor and all this conductor and cable, actually cables. I just wanted to ask one thing, like in a previous, like I said 3 years back, the con call you have said, we always been into this developing new programs and new products, which has been fire line the target, which is currently now we are seeing that OPGV is the product which has been currently into the stage. So what are the current decisions which are making, which can be lined up in next 5 years, where there is a little bit of ahead of the curve for the competition? That's my question.
So I'll take that question. So we've constantly been working on innovation. So a lot of the conductor lines which you're talking about, we started working on it 7, 8, 10 years ago. Now OPGW is picking up because data is a new oil. The railways, we've developed a whole lot. We've also developed a range of copper magnesium. Now the entire basic electrification is a pure copper. But the moment you start going to high speed, you need copper magnesium. Apar is the only company that has a full product line ready. So, as customers, we are constantly in touch with customers and the planners that are there of these large customers to understand in which direction they're moving. But because there is regulation involved and all these things, it's difficult for you to determine when it will come. Like we were ready with copper magnesium conductors 3 years ago. But now we see that, as they start signing up higher speed lines, they will need that. So we continue to keep on investing, in terms of this. Generally, you will find that HTLS type of conductors, OPGW, even the CTC, whatever products we have classified as premium, those products today are at the relatively cutting edge of what can be used by a customer, and will remain for the next few years. And then as and when they keep coming up with more requirements, we will keep adding to it. So it's like a moving target, it's not something where you have an end destination here. As time passes by, as requirements keep improving and changing. So for example, with the Indian Navy, they themselves don't know the specification of what they want 3 years hence. At any point in time, if you go to the Apar Khatalwad plant, you will find senior guys from the Navy there who are talking to our chaps to see how it can be redesigned, and different prototypes are being made, etc., etc. So it's like it's a moving target. But the key here is that if you're the first port of call for customers when they have new requirements, then that is the right positioning for the company to be in.
Okay, sir. That's my answer. Thank you so much.
All right. Thank you.
Thank you. The next question is from the line of Amit Anwani from Prabhudas Lilladher. Please go ahead.
Hi, sir. My first question is on the conductors business. As we have been seeing, there is good contribution increase from the premium products which is happening. Just wanted to understand what is contributing to this, largely between domestic and global market. What sort of contribution is there for the premium products?
So overall proportion of exports in Q1 was about 42%. Exports
Yes.
as a proportion to the total sales.
As a percentage to premium products?
The total.
Honestly, we don't want to get down to giving granular breakups of these.
No, I just want to understand what actually is driving the premium products. So if you could just highlight something about
what is driving the premium products on the conductor side is as follows. The HTLS, which is a high efficiency, and the conductors with a low sag, what is driving that demand is increased transmission corridors, meaning the transmission corridor needs to increase the amount of power that is transmitted on it.
त्याने तुमच्या कॉलला होल्डवर ठेवला आहे. कृपया लाईनवर.
Hello.
Yeah, hello.
Yeah. So it puts the it's being driven by the increased electricity requirement in urban areas or in concentrations. That's what is driving the HTLS business.
But
what
is
is driving
this
the
global
OPGW is at all the railway lines and all the other lines which are coming up today, instead of just having a plain vanilla steel core, there is a OPGW, which is a optical ground wire core, which is running so that it can transmit data. And today the two companies that transmit the largest amount of data in India are the Indian Railways and Power Grid Corporation of India. So all their lines, they are starting to specify now with more and more of the core coming in. Then you've got the CTC, or the copper transposed conductors. So that improves the quality and consistency of the core of a transformer. So slowly customers have started specifying that, because they want better quality. The core of the transformer determines finally the life of the transformer. If something goes wrong with the core, you have to take the transformer offline and then spend a huge amount of money to refurbish it. And in the meantime, you need to have a spare one so that the circuit continues to run. So there are different drivers to these product lines. But what I can say is that each one of these is in an area where the utilization or the usage of these conductors is growing. And that's the reason why we've classified that into the premium products. The conventional conductors have been around from the time before I was born, which is in the late 50s, from the 50s.
Thank you.
Does that address your question?
So the current speaker has got disconnected.
Okay.
We'll move to the next question from the line of Sachin Kasera from Swan Investment. Please go ahead.
Yeah, good afternoon, sir, and congrats for a very good set of numbers. I just had two questions, and they are a little bit more from a medium to long-term perspective. So you did mention that one of the key things that you are looking to achieve by doing all the premiumization is to try and target a 20% ROE, or at some 17% plus right now. So if you could tell us that, I think the way we are going, I think we should do that in the next few quarters. But something like from a more medium perspective, 5-year perspective, do you think that we are investing into enough new products, new premiumizations, new brands, new type of businesses, where there could be life where, we could look at even maybe a 25% ROE, say 5 years down the line? Or you think the type of business we are in, the business model we have, we will max out at 20%?
I think aspirationally, obviously, we want to go beyond 20, but realistically, hitting that 20% number also has been a moving target, because as we keep reinvesting in the business, we don't dividend out all the profits. Some of the profits, 65 to 70% of the profits remain within the company. So to keep achieving a 20% ROE also is a moving number. So I think we will probably want to comment on that once we've hit this. At anywhere between the 17 and 20, the company will have a very healthy cash flow. And that's something that we haven't been able to achieve after we bought the cable business and have been continuously investing to grow it. So just to put things in perspective, in 2008-9, the cable business was a 100 crore business. Last year we did net sales of around 2,000 crores, and this year we plan to look at 2,600 plus. So there's a huge amount of investment which has gone in. The opportunity there continues to remain looking good. So moment you invest, then your ROE actually does take a little bit of a knocking. But the market is, according to us, the market on the cable side continues to look interesting. And we have fairly good, internal systems for asset allocation. And then based on that, you're just seeing the turnover of the company going up and the ROE going up. So I think first milestone is to get to 20, then beyond that, we'll, as we come closer to 20, we'll start brainstorming on taking it further.
Sure. And second question was on the cable segment. You mentioned that the market is very, very large, 60,000 crores. And you right now mentioned the way on the cable business. So what would be your aspirations on this overall 60,000 crore pie in the next 5-6 years?
So I just like to correct that. 60,000 crores is the domestic market. And then when you start looking at markets like North America and all, they are many-fold larger than, couple times the size of the Indian market, just simply because of the size of the country, which requires to be wired up. So we don't have a market share target as much as continuously wanting to grow. I think in the cable business we want to play what Simon Sinek says is the infinite game. We want to keep, because there is a long runway. You keep on working on new products, new markets. Keep investing in it, and it will continue to grow.
And you did mention that probably this is going to be the fastest driver in terms of the growth, and probably could also be one of the biggest contribution to your both top line and bottom line.
Ultimately, I believe that in the next 3, 4, 5 years, the cable business will become the largest business. And it's true only because of the size of the addressable market, both domestic and overseas. And so, we will want to continuously keep on making investments where it makes sense. As I mentioned, we have a good system internally of asset allocation. So if the asset allocation doesn't deliver a certain level of return, then we would then hold back, that sort of investment. But I think in the next few years, the opportunity seems to be there.
Sure. And just one last thing regarding, mentioned that we always aspire to become better, and we also focus a lot on premiumization and new products. We have always seen that, for that the companies need to invest a lot in terms of R&D. So, now that once we achieve this 20% ROE, maybe for the next leg of journey where you're hungry for more. Do you think that as a company, we will need to substantially scale up in R&D, invest a lot in technology, and if yes, what are the type of steps we are doing to, do something like that?
So we have, DSIR approved, R&D facilities in each of the 3 businesses. And we have people who are constantly working on this. We don't capitalize, we just expense our work, because in some of these cases you don't know when the products will actually hit the market. So I'll just give you an example. We've developed this medium voltage covered conductors. We've been desperately trying to sell those in the Himalayan region within India. And now some business has started coming up. But we pitched this to the Nepal Electricity Authority and the Asian Development Bank. And they said that this is the number one problem that's there, because as the snow settles on conductors, the conductor snaps. So Nepal is now converting 5% of its conductors every year into MVCs. So we've got 3 years in a row we are supplying that. Of course, it's a competitive global bid, so Chinese companies, everybody bids on it. The bottom line is that, as you keep developing products, you keep showing it to customers. You don't know where finally and which customer will actually end up observing it. Now today, if you see, Uttarakhand is in the worst shape in terms of power deliveries, in the mountains. And the solution is to use the same MVCC. So now I believe that they are in touch with us trying to figure out, how much money is required, what allocation. So it's like a moving target to do, all these specialized products. We expense the development cost, and then we also expense the cost of actually the sales. So people traveling, making presentations, pushing all that. So it's all written off in the year in which it has been incurred. It also then, our competition doesn't know how much money we put into these products, basically.
Sure, but will you be able to quantify how much we spend in R&D every year in terms of OPEX? Any number that you can share with us?
We don't want to share that number.
Okay.
But it's been increasing year on year, and as you can see from the finished products, because by saying that we spent XYZ number, it doesn't mean anything. Our company motto is tomorrow's solutions today. Unless the customer buys the solution, all this is an expense. So whatever it takes for us to find the right solution for the customer, we incur it and we expense it.
Sure, but is it increasing as a percent?
That's our philosophy.
And is it increasing much higher than overall company in the sense, if earlier say you're spending X percentage of revenue in R&D, 5 years back?
Yes, absolutely. Because as I mentioned, the R&D actually has two portions. There is one portion which is actually sometimes the lower portion is to develop the product. The bigger portion and what takes significantly more time is to spec the product into, because all these electrical companies are regulated. So finally, no matter who does it, if Mr. Adani wants to put something in, he will have to get approval from the Central Electricity Authority to use that format. So it's difficult to put timelines to it, etc. So that's why we end up just expensing it, and it's an infinite game. We just keep on working on it. I'll give you another example so that it puts it in perspective. So the Navy has something called pressure tight cables, which they use. So they started off with a PT10, and today in 6 years we are now graduated them to PT72. So they can withstand 72 times the pressure of water. So as submarines get larger and as requirements go up. So this is something which is a work in, the moment the Navy says I want to now graduate from 10 to 15, 15 to 20, we just get to work and start working with them to figure out how that can be delivered.
Sure. Got it. Thank you.
Thank you. The next question is from the line of Gunit Singh from CCIPL. Please go ahead.
Hi, sir. I would just like to know what is the standing today, what is the peak capacity revenue that we can expect, like if we are operating at a peak capacity with our current capacity?
So, in our oil business, we can increase the lubricant side we are running basically the entire lubricant complex on 2 shifts. We can run a third shift with the same equipment in place. As far as white oils and all the bulk oils are concerned, we can easily match, that sort of a number or more by making debottlenecking investments. On the conductor side, as Chaitanya Bhai mentioned here, we could probably, and of course it depends very largely on the mix of product, but we have headroom to go from 130 to about 145, maybe 150 depending on the product mix that is available. And, again over here, our whole focus has been more not just on, we would rather drop some conventional conductor business and concentrate on, the premium products. So in that sense, you can still increase your top line and your contribution margins, etc., without really increasing capacity, too much. So if you say basically you got a room of around 10, 15%, 20% in physical volume, but in terms of mix of product, etc., it could have a larger impact on the top line. And in our cable business, basically the power cable and the elastomeric cable is running at the high tension cables are running at around 40-50% capacity. The LV cables which are going into a lot of the US infrastructure, solar, etc., that's running right now at 100%, and we have some expansions that are going in place. The elastomeric mix of cables, when you put the E-beam in there, basically that will increase by 33% compared to now, because that's the capacity increase that one more machine will bring in for the cable side. The optical fiber, we have at least 50% capacity available with us, and that is just driven by market demand.
Right. Sir, can you give any conservative guidance for the FY23?
So there are a lot of moving parts there, but in short, we are looking at, a 25%, kind of increase over what we had in the previous year. That's a sort of level of, that's something that we think, is possibly achievable.
All right. My last question is, can you just throw some light on the 3,000 crore plus other items we have in the balance sheet?
Sorry, which one?
We have around 3,000 crores plus of other liability items in the balance sheet. So can you throw some light on that?
It should be largely part of trade payables. Which line item you are talking of? Which particular line item?
I don't have it open in front of me right now, but
the liabilities are
mostly be trade payables.
Trade payables is part of trade payables. So if it's such a big number, it has to be part of the trade payables. Maybe you can let me know separately once you have from which source you are taking, and then we can connect on that.
So do we move on to the next question?
Yes.
We have the next question from the line of Ritika Gupta, an individual investor. Please go ahead.
Hi, I just had one question. Is there any update on the MOU that we signed with the Saudi Aramco base oil company?
So, there's a certain laid down process which exists in Saudi Arabia. So, unless you first, so it's at a very early stage, but the reason why Saudi Aramco and its Loop subsidiary are talking to us is that we have the largest market share of transformer oil in Saudi Arabia, and it's part of their localization program. So it's a fairly long, drawn out, very formal process. So you sign an MOU, then only will they entertain you to sit and meet and show you land parcels and stuff like that. So it's a process that will take at least over a year before it can be closed.
But do we have any revenue target that we expect in case this fructifies?
So today we do business in Saudi. During this last 4-5 years, Saudi Arabian business actually was very badly affected. So from its peak, it was down almost 60% because of infrastructure not going in. With the current price of crude and with the current ruler there, who is pushing these programs. They have some very ambitious programs in terms of setting up manufacturing in Saudi Arabia, which is hydrocarbon or electricity based. And so depending on how that goes, you will see the beauty of a transformer oil and facility is that it's not very capital intensive.
Okay.
So our strategy would be to secure, and once the MOU is done, then they'll go to the next step of allocating land and providing you on tap utilities, etc. It will be right in the vicinity of the refinery.
Okay, so nothing
it's a very advantageous situation to have if the business actually starts going up. Also, Saudi Arabia has come up with a marking system that the local content ends up giving you a weightage in terms of the competitiveness of your price. So if you're 100% import, then you'll have a penalty of almost 15%. So it's like a very structured system to enable companies to come and start manufacturing in Saudi Arabia. So I think it's a strategically interesting step. It will take some time, and it's not going to skew the transformer oil numbers in a very big way. But then when you get aligned to the largest oil company in the world, then I think there are benefits that come out of it.
Yeah. All right. Thank you.
Yeah.
Thank you. We will take the last question from the line of Harsh Diokar from HT Investments LLP. Please go ahead.
Yeah. Good evening. Thank you. First of all, congratulations to the management for a good set of numbers, and thank you for taking all of the investors' calls patiently on a Friday. Question is regarding exports. We've seen significantly in these past quarters. From an aspiration standpoint, are we focusing our export more than 50% of to get management?
So I think to sort of answer that question, our focus is actually not just in terms of what percentage of our revenue should come from exports. We want it to be something in the range of between 40 and 50%. Given the fact that many markets have opened up with this China plus one, etc. So if you wind back in time, 5 years ago, there were no cables really worth talking about going to the US market or going to the Australian market. And the European market was completely shut to Indian players. Now, they are coming in here and, a whole lot of approvals and discussions are happening, inspections, in the last 3-4 months, you've had people visiting who have not been able to visit in the last few years, flying in from overseas, having meetings in the factory, etc. So, I think if you look at that, the quality of the companies or the countries we want to focus on, those are now open for doing business. And in fact, I had mentioned earlier in the last plus earnings call saying, all these countries are now open to doing business with India, which was not actually something that was that easily available. So, and if you see the destinations where the product is going, it's largely going to the United States, Europe, and Australia, which are fairly advanced and sophisticated markets.
Sure. Thank you, sir.
We don't have a percentage, but I think we will strike the right balance between domestic and export. On power cables, we get better realizations from the US market than from the domestic market, especially on the on the LV cables, light voltage cables. So we are really looking at where you get the best net back, where customers are laying an emphasis on quality, and accordingly, we are targeting the different markets.
Got it. Thank you,
I'll
sir.
tell you one thing that you will see over the next few years, that the export percentage of the overall pie will remain strong, and it will be in this range or maybe slightly higher. Does that answer the question?
It does. Thank you, sir.
Thank you. I would now like to hand it over back to the management for closing comments.
Thank you very much for taking time out from your busy schedules in joining us in the quarterly update call today. We wish everyone the very best of health and look forward to continued participation and interaction in future quarterly update sessions. Thank you very much.
Thank you. On behalf
Yes,
of
thank you. Goodbye.
Thank you. On behalf of Apar Industries Limited, that concludes this conference. Thank you for joining us, and you may disconnect your lines.